Hello learners, welcome to Cash. In previous video, we have learned what is preferential capital, what is loans, what is borrowings, what is debentures. Now in this video, we will learn what is deposits and why company accept deposit. When we talk about deposits, it is same concept as investment. There I said, when investor wants earnings, he invests his money somewhere and expects some return. Like that, when it is investment in the point of investor, it is asset for him. When company accept his investment, that is called deposit, and it is liability since it has to repay it. That is the obligation to repay money. Why deposit? It is accepting deposit, not asking for deposit, which means company is telling that I am ready to accept deposit and pay you interest. Company is not asking for money and paying interest. That is the concept of loan and debentures. It is running with good cash flow, but still want to expand business with lower cost. Investor trust the company with good credit rating. So since it is not asking but ready to accept money, so it pay lower interest. By this, company will save cost in two ways. That is, it pays lower interest, and on such interest, it saves tax. For these reasons, company accept deposit. But since there are strict restrictions in company law, many company accept deposit only when they are sure about their future performance. Now, let's discuss the topic of provisions. It is an amount kept aside from a company's profit to meet a liability or loss that may happen in future. Not an expense but related to future obligation. Company is making provisions because it expects some future liability or losses, so that it is recognizing today, so that it is preparing itself for such liability or losses. That's why they make provisions. For example, provision for bad debts, provision for taxes, provision for warranty claims, etc. Then you may ask, if it is happening in future, then let the company face it in the future only. Why provisioning today? Company make provisions because it has to follow accounting concept called accrual system, which says every income and expenses must be recognized in the period which they relate to. For example, if company makes sales on credit, it should be recognized immediately whether the payment is received or not in that year. For example, now a company makes sales to Mr. A on 20th March of 2025. Mr. A said he will pay by 30th April of 2025. Now, company thinks, what if he don't pay full amount? So it makes provisions for some amount as loss, that is called bad debts. This will be shown in debit side of P&L account, which is loss or expenses. Since it is loss, even if it may happen in next year, the transaction is happened in current year. That the transaction means the sales happened in the current year. So as per accrual concept, provision should be made this year only. So that is the reason provision is made. Then you may ask, why don't company provision for profit or incomes, only for losses or expenses? Because the concept of prudence or concept of conservatism says recognize only liabilities and losses as soon as possible, but don't recognize profit or incomes unless they are certain. For example, accounting concept says company accounts are maintained in going concern concept, which means company will run for a foreseeable future. So just because it is going concern, company can't recognize sales of next 100 years today only. What if company gets liquidated next year only because of huge loss or because of any fraud happened in the company? That is why provisions for profits or incomes are not made until they are certain. The provisions for losses or expenses should be made this year only, because company has to show their investor the company's actual financial position. It should not mislead the investors. So for these reasons, provisions are made. Now, what is creditors? The person or entity to whom the company owes money for goods or services purchased on credit is called creditors. Obligated to pay money, so it is liability. All liabilities shows credit balance, so called creditors. Creditors fund the company in the form of goods or services for short-term period. Let's learn from an example how they fund the company. For example, A Limited purchased goods from B Limited. Now A Limited don't have enough money to repay, but immediately can't approach the bank for loan to repay B Limited. So it asks B Limited for some time. This time period is called credit period. So in this credit period, A Limited can run its business and earn some money. With that money, it will repay to B Limited. So indirectly, B Limited funded A Limited by supplying goods or by providing services, and also by giving credit period to repay its money. So with this, we have learned almost all balance sheet terminologies, that is equity, preference, bank loan, debentures, provisions, creditors, plant and machinery, furniture and fixtures, investments, inventory, debtors, cash equivalents, loans and advances. In upcoming videos, we will learn how to prepare balance sheet, why it is prepared, and why it is prepared as on particular date. If you found this useful, like, share and subscribe to stay updated for the next part of our accounting journey. And if you have any doubts, comment below. I'll make sure to answer them. Learn smarter, understand deeper. Thank you. Stay tuned.